Hey, good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And it certainly feels from the last time we met a week ago that everything seems to continue to align to more of a bullish stance here for the equity markets. You effectively have most of the major indices either at all-time highs or just within very close to all-time highs. Most of the other markets, bond markets, um, the the sector rotation kind of pointing to a fairly positive outlook here for equities. Um, a very almost one-sided view here from investors, with a fairly bullish optimism in the air. So let's take a look at kind of where the charts stand and kind of how we are viewing this from an outlook perspective. So the S&P 500 continues to march on to new all-time highs. We've seen a fair amount of low volatility periods here on the S&P 500. Very small incremental moves every single day that continues to push higher and higher on the S&P to new all-time highs. This is certainly overall, generally speaking, a positive here for equities to see kind of that continuation higher here. You see that on the S&P 500. You also see the NASDAQ 100 continue to move, grind its way higher here as well towards its all-time highs here, just above $500 here on QQQ. So far, we have not had confirmation from the NASDAQ making a new all-time high just yet, but we are, like I said, within just spitting distance of the NASDAQ 100 getting there and potentially exceeding its recent all-time highs. If we do break out above that double top, that certainly would be a bullish signal here from the equity markets. And then you have the Russell 2000. Russell 2000, as you can see, did manage to get back to its all-time highs so far based on yesterday's price action. We see a little bit of a rejection here, so did not manage to break out above those all-time highs, showing a little bit of resistance here. And the question is whether, that's a bit of a warning as to what to expect going forward from, the S&P and the NASDAQ as they just print new all-time highs or just shy of all-time highs. But certainly sentiment overall has been fairly positive here for equities, especially with analysts slashing earnings expectations going into earnings season. We have had a pretty low bar that companies have had to meet for earnings season this quarter. And certainly we expect a higher percentage of companies to beat on earnings as a result of that. And that, always presents a bit of a bullish backdrop here for equities over the next few weeks as we kind of continue embarking on a fairly heavy calendar from an earnings perspective. Now, if you look at the RSP equal weight S&P 500 index, we see one of the few times where the equal weight S&P 500 index largely is trading in line with the market cap weighted index, meaning we have fairly broad participation on the rally here for the S&P, with participation from, not just a few major tech stocks dragging the markets higher, but overall broad participation. We're starting to see that reverse a little bit here over the last trading session. We're starting to see a little bit of underperformance here of the market cap of the equal weight versus the market cap weighted indice. So we'll continue to monitor this to see if this is really where things start to diverge a little bit, or if the broad-based rally can continue on its trajectory like we've seen over the past couple of months, really. And then when you look at kind of growth versus value, you see that there's really hasn't been any outperformance from growth or versus value for the last 2 months. we've been kind of starting to trade into a little bit of an apex here, and you know, is this about to start to break out here a little bit here to the upside where growth starts to outperform value? We'll see. Um, Generally speaking, as you can see, growth continues to kind of, on average, outperform value by a little bit, not by much, but we're seeing a little bit of that here right now. You have commodities finding a little bit of stability here around the 50-day moving average here. We saw gold march on to all-time highs as oil prices sort of collapse a little bit on the back of um, some of the geopolitical risks in the Middle East. I wouldn't quite say declining a little bit, but the concerns around Israel striking Iran's um, oil producing capabilities, those risks seemingly have come down substantially, which is why we've seen a pretty fast collapse in the price of oil, almost as fast as we saw oil spike. We're seeing oil give back those gains on the back of those risks being dialed down quite a bit. So commodities so far finding a little bit of stability here, kind of balancing out the demand for gold versus that kind of decline in demand that we've seen here from oil. You have the HYG, high yield corporate bonds, as you can see, failing to make a new high and potentially starting to reverse a little bit here. So far, up until now, high yield corporate bonds have been very much on a risk on trajectory, showing that there's little concern from the corporate bond market with regards to credit risk. We'll see if that starts to take a little bit higher, especially as we're starting to find ourselves in an environment where the communication from the Fed is slow and steady decline in terms of rates. We've seen 10-year yields continue to stay above 4%, really speaking to the fact that market expectations are for borrowing costs to remain fairly elevated. That's going to have an effect on both consumers who have in the past year or so greatly expanded their amount of revolving debt in the form of credit cards and other debts. And then also for both governments and corporations, the amount of debt that's coming to maturity that once were lower price debt or debt that had carried a lower interest rate, is finding themselves in an environment where they have to refinance that debt in a higher interest rate environment. So with 10-year yields remaining above 4%, it just provides an additional challenge here for everything from the US government to corporations that have to borrow using the debt markets, going to have an influence on those things going forward. So the 10-year yield, or rather the persistent higher interest rates, has that flow-on effect into the bond market, into equities, and ultimately into consumers' spending habits as well. So this is something that I think is really important to pay attention to here right now. We're starting to potentially see a little bit of weakness here. As you can see, it has underperformed the S&P 500 by a little bit here over the past couple of months. So we'll continue to keep an eye on that. We see VIX trade around 18%. And, one of the things that's kind of very odd about the markets is that you have effectively the S&P 500 making back-to-back all-time highs, but the VIX has remained extremely elevated for those types of conditions. I couldn't find another instance going back where the S&P 500 made back-to-back all-time highs and the VIX remained that high. It really speaks to the mindset of investors right now, near all-time highs. There's a lot of fear, you could say, of equity markets at all-time highs that investors are demanding a fair amount of protection here as they reach all-time highs. sort of investors feeling that FOMO, fear of missing out, but also at the same time wanting to make sure that they're protected to the downside. So there was a lot of buying of put protection as we reached new all-time highs. That VIX got bid up quite a bit into that 18, 19, 20% as we printed new all-time highs. That's retreated a little bit here, but still remains fairly elevated. And that does provide an opportunity for option sellers to capture some of that yield. And you can do so even with a directional view, whether you have a neutral to bearish directional view and you would sell strategies such as covered calls or even credit spreads, or if you have a bullish neutral to bullish view, selling cash secured puts, selling credit spreads, those types of strategies are suitable for this type of market environment and will give you an elevated amount of premium right now for those specific types of strategies. As you can see here, the 10-year yield actually continues to climb. I think we had some Fed presidents speak over the past couple of days and kind of reaffirm their views that they believe that the Fed should keep on a very slow and steady course with regards to reducing rates. That has sent borrowing cost even higher here, meaning we've kind of completely erased any possibility of a 50 basis point cut here from the Fed. The markets are expecting, only 25 basis point cuts, and it's not even clear that we'll get, 100 basis points of cuts in the next, I'll call it 14 months or so till the end of 2025. So borrowing costs have, in the short run, started to rise. And like I said, that is going to have a bit of a knock-on effect as, you have sectors like real estate, that have performed quite well here over the last couple of months on the expectation that rates are coming lower. But as you can see from the bond markets, that expectation has kind of taken a bit of a back seat at the moment as borrowing costs have gone back to the levels that we saw just a couple of months ago before the Fed embarked on that rate cut cycle. You have bonds continuing to be under pressure here. Treasuries, as in terms of the U.S. government, we just saw recently, the U.S. government's budget on servicing its debt is now the largest line item in the U.S. budget next to defense spending. This is the first time we've seen that. So as borrowing costs continue to rise and remain elevated, that's going to put a damper on the spending the U.S. government is going to be able to do, because more and more of the budget is going towards just servicing the debt itself. So this is something that is an important dynamic to understand and keep an eye out on as to, whether or not markets see some risk, if you will, more of a technical risk here. Obviously, the U.S. government is not going to default on its debt, but more so from a technical default perspective, any concerns that there's a credit risk concerns from the U.S. government debt. So that's something that, we've seen Moody's issue warnings, negative warnings with regards to the amount of U.S. debt that is now outstanding and the amount of interest that's required to service it. We're talking about trillions of dollars now just on servicing the debt, not even on on other items. So this is something that I think is going to become more and more of an issue, especially if we see 10-year yields remain in this, a little over 4% level here in the short run over the next couple of years. We continue to see the dollar make a pretty spectacular run into that 104 level here. It does reach fairly, I would say, overbought conditions here for the US dollar on both short-term and long-term trends. This does start to favor, in my opinion, adding some bearish exposure here for the US dollar, especially if you believe that, the rate cut cycle is going to bring down these rates a little bit here in the short run, or at least prevent them from continuing to rise here in the short run. Gold, as you can see recently, just shy of 2750. I believe intraday we did get to 2750, which is our upside target here for gold. Where my expectation is that now that we've reached that 2750 upside target, is that we could, in the short run, see a little bit of consolidation. But I'm curious as to if we do break out above 2750 and continue moving higher. But we have reached at least my upside target here for gold after it broke out from that 2450 highs back here in July. Oil, as you can see, is settling around the $70 mark here. It seems to have found a little bit of a floor here just below $70. But it is still trading below kind of that $72 resistance level here. So oil demand clearly not particularly there. Supply remains fairly robust. It really would require some supply cuts from OPEC nations to kind of lift oil prices up from where they are. But being down here, this is going to obviously be beneficial for inflation. It's going to be beneficial for stocks that are sensitive to oil prices, such as oil companies, obviously, but also stocks like airlines that have been performing quite well recently. And then looking at sector rotation, we've seen a fair amount of sector rotation here, but technology so far has not provided much leadership here over the past few weeks. On the flip side, consumer discretionary has seen a fair amount of outflow here, underperforming the S&P 500. So this is certainly one of the more offensive sectors, showing a little bit of weakness here. And I think this is important to focus on and understand if that continues. Communications have shown a little bit of weakness here over the past couple of weeks. Financials, on the other hand, have seen a fair amount of inflow, and obviously with earnings season kicking off fairly strong from banks, that's provided some performance here for XLF, the financial ETF. But otherwise, you see consumer staples underperforming. This is a defensive sector, underperforming, but certainly showing that consumers are not particularly strong in this particular case. Healthcare, as you can see, trading below the 50-day moving average, underperforming the S&P 500 by a very wide margin in the last 4 or 5 weeks. You have materials also underperforming a little bit here over the last couple of weeks, forming a bit of a double top here. Industrials, showing a fair amount of strength here, actually, industrials. One of the sectors kind of diverging a little bit from materials. Those two typically move more hand in hand at the moment. And then real estate, as interest rates continue to rise, this is put real estate, the rally here in real estate, under pressure. And I think there's potentially at risk that, XLRE breaks below the 50-day moving average and actually continues moving lower from here. Energy, obviously, as oil prices kind of trade below or just around that $70 mark, you're going to see energy stocks struggle here in this type of market environment. And utilities so far has managed to continue that upward trajectory here on XLU. So overall, the sector rotation has not been particularly positive. It's not been a very strong risk-on response here that we've seen here from a sector rotation perspective. We see some of the leading sectors seeing outflows. We see the defensive sector seeing outflows here. So this is something that is a little bit concerning to see in terms of the market internals based on what we've seen from equities. And then lastly, home builders, as you can see, showing a little bit of underperformance here after forming what is a bit of a triple top here. Again, as interest rates rise, home builders under pressure here, and semis also as well, failing to kind of break out here above that 235 resistance level. You have also a bit of a triple top here that has failed. We'll see if that can continue to the downside. If we continue the downside, we're looking at going back to the 200 levels here. on the SACS ETF. And we'll take a look at kind of this individual names that could potentially contribute to that underperformance here at the moment. So, starting off the week, we had a pretty positive start, but as you start to see the market internals play out and you start to see how markets react to some important resistance levels, we're actually starting to show a little bit of weakness here. And I think that is something to be a little bit cautious of, especially as you think about the bigger picture. The S&P is trading above 21 times forward earnings. And while short term, we continue to remain potentially optimistic because we're heading into earnings season with a relatively low bar. Expectations are for more companies to beat on earnings than on average, providing kind of that bullish backdrop for equities. But, if you zoom out to the big picture, we're trading at 21 times forward earnings. Historically speaking, that's very high. If you look at the 10-year expected return when valuations are that high, the expected 10-year return is largely flat. It's zero. And the correlation between forward PE ratio and long-term returns, such as 10-year returns, is extremely strong. That relationship is very, very strong. And what that speaks to is the fact that even if you maintain a short-term bullish view here, you have to maintain a bit of a medium-term concern and caution that the markets are going to pull back substantially for the equity markets to effectively 10 years down the line be back at where we are now. So it's definitely one of the more challenging environments to trade because you have a fear of missing out, right? As markets continue to march higher here, you're very concerned about the valuations that you're paying for stocks at these specific levels. And, you have interest rates that have kind of reversed back above 4%, really speaking to the fact that treasuries have come under pressure, inflation seemingly potentially returning back to a bit of a spark in terms of inflation, and just the knock-on effects of all of that into the U.S. consumer, which up until now have remained fairly resilient, and the job market came back in September with a really strong number. But was that just a bit of a fluke here in terms of September, and October is going to go back to a weaker number that we saw here in July and August? Those are some of the big picture things that you should be aware of. I do see some downside risks here in this current market environment, given kind of the things that we've been looking at. So with that, that covers what I wanted to share with you here today. Hopefully this gives you a good understanding from a broad picture, kind of what our views are here for equities, and gives you some food for thought here going into a big earnings week this week.